Hey, welcome back. UiPath has had a very rough time over the past years, crashing by more than 80% since the IPO and recently getting to new all-time lows. Still, they crashed once again after citing uncertainty around the US government spending despite beating expectations and giving a pretty good outlook, but more about that in a bit. What they do, really quick, they make bots to automate processes that go on in a company. Think about email or invoice processing or data entry, shipment tracking, customer support, things that can potentially save a lot of money and especially time in any company. It's basically very cheap workforce for relatively simple stuff that's available 24/7. They have limited decision-making capacity but also make less mistakes and are much faster, but now, especially with AI, the long-term potential could be very impressive. What's also impressive is that the company actually managed to make a positive free cash flow once again. Currently, that's a ratio of around 20, which is not bad for a high-growth tech company. It's true that the growth slowed down recently, but the environment also wasn't the best. This year, they see a roughly 20% increase to 370 million, which allows the company to improve without getting debt or do dividends or buybacks, which they actually do. They don't pay a dividend, but had a more than $500 million buyback program since 2023, which should be fulfilled pretty soon, so expect a new one to be announced. To be fair, I like seeing a company focus on buybacks when the stock is down so much despite the business improving. The annualized renewal run rate has been growing very well and they now expect it to reach even 1.8 billion this year. That's basically the annualized subscriptions, so somewhat of a recurring potential source of revenue that should offer a bit of predictability to the future. The closer it is to the actual revenue, the better, because it shows that they are either adding new contracts or clients opt more for subscriptions rather than a one-time thing. The gross margin is also massive, something above 80% thanks to the business model, and potentially this could turn into massive net margins in the long term. Financially, we see a very good position with the cash and marketable securities well above the total liabilities. They also don't have debt, so if they really need it, they can borrow and develop that way. So no interest expenses, but around 50 million in interest income that they can reinvest in marketing or other expenses. In fact, we see a majority of the operating expenses being sales and marketing, which is very important for a company like this. The potential customer lifetime value through subscriptions and maintenance is very significant, so they also spend a lot on marketing. If they secure a contract in a department thanks to attractive prices, it's possible to see that company want to get bots in other departments, potentially adding lots of subscription revenue in the long term. Now, the thing with this company is that they are all about growth. Under-deliver or have some negative outlook and there goes the stock price, as we can see. However, it goes both ways, so if they recover and continue above the market's expectations, we can expect the stock to follow. Right now, the outlook and sentiment are bad and there is a lot of uncertainty around AI in general, so the stock got to all-time lows recently. They crashed again by 15% on earnings despite not only beating expectations but also issuing an optimistic guidance, but the macro environment is unpredictable and even challenging. Now, Alphabet actually used to own quite a bit of them, and this was one of what the company calls bets. They sold the majority of it at a massive profit, and now Capital G, Alphabet's equity fund, has something like 1.3% of UiPath. What I think could happen if they continue to fall is Alphabet, or honestly any company with a bit of money, could scoop them up now when the company basically just became cash flow positive. This company has many clients worth tens or hundreds or even thousands of billions that can issue a bit of stock and get them at a very nice ratio. Not only would they save on the cost, but the potential to grow combined with actually very solid cash flows for the price is really tough to ignore if they continue to fall. I see expectations in the 17 to more than 40% compound annual growth rates for the robotic process automation market, meaning actually massive potential regardless. Even without a buyer, this company and especially what they do should be pretty much essential to the future. Especially now with AI, you can really automate a ton of processes and save a lot of money as a company. Anyway, more about this in the valuation. Now, the problem with any tech company is the competition. They are a leader in RPA, but you still have Microsoft, IBM, SAP and many others doing not necessarily the same thing but potentially getting into direct competition. Now, I also want to talk a bit about buying this during the IPO. Back then, you had no idea what the company could do and they were losing a significant amount of money, but the media, Katie Wood and stuff praised them as usual. People like this will always come and go in the market, but hopefully not with your money. Media literacy, I think is the phrase, should be a thing especially in finance because there is lots of money behind it. Always do your own research and take even what I say with a grain of salt. Anyway, that was during the IPO. From the looks of it, things are pretty much the opposite right now. Now let's see a valuation. In a bad scenario, let's say they develop, but due to competition they have to cut the margins and only make 250 million per year in the long term. Say the ratio is at 15 to show a bit of optimism because the industry still has potential after all, and that's a market cap of 3.75 billion. Not accounting for any buybacks or issuing, that's a price of 6.82, meaning a pretty significant loss. But as I said, wouldn't something like Google or a client or a competitor just buy them in such a scenario? Just getting the clients and already recovering some money thanks to the balance sheet could potentially make it too cheap to ignore in such a scenario. In a second scenario, let's say they get to 450 million in half a decade, which isn't really much if they continue as they expect. You know, if they get a base of clients and continue to reinvest in marketing to attract even more, it can compound really well. For a ratio of 20 to show some pessimism because it would imply a potentially lower than expected growth rate, that's a 9 billion market cap. That's a price of 16.37, meaning pretty much a 50% profit plus potential from buybacks. They were at much more, even less than a year ago by the way, so the market could get more optimistic. Now, in a good scenario, let's say we see a lot of growth in the market, although less than projected, managing to get to 1 billion in cash flows in half a decade. Again, it's not amazing for a high growth tech company, and we've seen many others multiply the revenue and cash flows before, and the expectations in this market are much higher. Say the ratio is at 30, which isn't much at all for such a scenario, it's common to see them even in the 50s, 60s, and that's a 30 billion market cap. With zero net buybacks, that's a price of 54.58, which is actually well below the IPO level. So pretty much a 5x in maybe not even such an optimistic scenario. With potentially double-digit buybacks from the current level and a better ratio, this can realistically be even a 10-bagger in such a scenario. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. For me, I'd say anything around 9 to 10 could be a good level to enter. The downside would then be limited by a potential buyer, although it can always fall even more, and the upside, even in the second scenario, wouldn't be bad at all. Again, add some buybacks on top and even the second scenario could become a 2x from that level. So, an interesting company that should have long-term potential. Very healthy, can develop a lot, can even get some debt if they need it, and very importantly, they already make pretty good money. The environment wasn't necessarily the best, but they could use the time until we may see more investments in RPA to improve the product, maybe integrate AI even more and the overall company. Plus, the potential, if they continue the buybacks and the environment improves, could make this into a multi-bagger. But of course, there is also risk and huge competition, although if it continues to fall, I think it may become very much worth it for me. Right now, we can see that the market is really giving up on it, which is usually a very good sign for me. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.